Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Greene is the nation's foremost authority on growing your portfolio companies with direct response marketing. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity firms, venture capital companies, and family offices, discussing developments and trends shaping the industry. These experts will share with you how they've grown their businesses and increased profit, and how you can too. And now, here's your host, Cliff Locks.
Welcome, everybody, to another episode of the Private Equity Profits Podcast. I'm Cliff Locks, your host. Today, we have our guest, Marcin Drozdz, who is the managing partner of M1 Real Capital, where he and his team focus on acquiring value-added multifamily properties throughout the Southeast. Over the past 16 years, he's helped acquire over 1,500 units across the U.S., established himself as a go-to in the world of capital raising and real estate acquisitions. Welcome to the show, Marcin.
Thank you for having me, sir. Really excited about it.
I appreciate it too. Tell me about your background and how you got started on the journey that brought you to where you are today.
Sure. I'll give you the short version of it. I, like so many other people, read Rich Dad Poor Dad when I was a teenager, bumping my way through school, and I read the book and I thought to myself, I can do this. And it was a little more complicated than Kiyosaki made it out to be in that book, as I quickly learned. But that book gave me a great framework and context. And while my peers and I were going to college and university, I was buying rental properties. Really quickly figured out that was what I really wanted to focus on. I initially thought I'd be a cop or a lawyer or something down the legal path, but the property seemed to make more money than I was going to make. So I thought to myself, this is probably a good path to pursue. So fast forward a few more properties later, I got recruited into a PE firm, private equity firm out west. And focused on the real estate side of the business. And it was like drinking from a fire hose. All of a sudden, what was buying a duplex became buying a 200-unit multifamily community in Arizona or Texas or so on and so forth. So that gave me a totally different perspective over the business, the industry, capital formation, structuring, how deals were done how deals people thought were done versus how deals actually happened. And it was tremendous. Great experience. Did that for a few years, then broke out on my own, started putting together partnerships, putting together sometimes 7, 8+ figure funds to go down and acquire, value add multifamily. And you blink and it's 16 years and you got a little gray hair on the beard, a little gray hair on the head, and lots of scar tissue along the way, and lessons and experiences, good, bad. It's been a lot of fun. So that's kind of brought us to today.
We share that Rich Dad Poor Dad. So I was introduced to that material as a young person also. I thought it was very valuable. A lot of our listeners have children. Mm-hmm. These resources can actually be vibrant to help the youth to understand they're part of an ecosystem. Mm-hmm. And I'm glad you built yourself a very strong career, and real estate has done well for you. And then you got introduced very early for private equity. So that's impressive, So
hey, I told them I'd do anything. I'll carry coffee, I'll print document, whatever. I just needed to get into the room, right? So managed to get in probably a little bit earlier than I should have, but it was a great experience regardless.
So what specifically that drew you into real estate?
Couldn't put it into words when I was a teenager in my early 20s, but it was simple enough for me to understand. And it was one of those things that I didn't think was going to go anywhere. Plus, when I figured out that the bank would give you 70 or 80 cents on the dollar every time you wanted to buy more of it, I was like, well, there's something here. Like, why would the banks not want to give you money for anything else? An operating business, forget about it. You want a startup? Yeah, that's great. Go leverage your house. But real estate, they're like, here you go. So to me, that was, because banks are always risk averse. So I always thought to myself, why are banks supposedly the most risk averse entities out there? And yet they're willing to give you 60, 70, 80% plus of the down payment to buy, a house, apartment building, plaza, whatever it was. And that got my curiosity early.
It's a good message, that due diligence on the early and understanding the business model. The banks really haven't changed.
No,
they're still adverse at this point. Freddie Mac, Fannie Mae, you can see that situation there with the CMOs. Having the banks have some skin in the game would be helpful.
As I got older and you start learning about going in cap rates and coming out cap rates and things like this, when you put that back into English, you think to yourself, okay, well, from a valuation standpoint, again, I couldn't verbalize this in my teens or my early 20s, but now as, a semi-grown adult over a period of time, I look at it and I think to myself, wait, essentially, what other business can I think of that you drive $1 of net profit, net operating income, and that $1 equals 20 to sometimes $27, $28 of profit? Because any other business in PE, you got that whole EBITDA thing, 2 times, 3 times, 4 times EBITDA. You don't get a 20x, 25x value on your business. So that was another thing. And today I can quantify that. But back then, it just, the numbers, the quantum, the returns, the relative to the risk, it just, and when you look at it that way, I'm glad I made that decision.
What are the basics regarding investing? What do you see as the foundation of sound investments?
Cash flow. And I know nowadays, 2020, 2022 and beyond, looking at cash flow is, watching the WeWork documentary on Hulu yesterday, and they had this interesting definition for EBITDA. They had this community approach to EBITDA. And, we all know where that went. And I mean, the basic principle, I think, of real estate should be, and it certainly is in our business, is cash flow. Can you generate positive cash flow? Not based on the future bump in rents, not based on the future value add or where you think the market's going to go, but right here, right now, if you just buy it as is, where is, with your existing debt structure, can you cash flow? And I think people would make different decisions if they looked at things that way.
That leads me to my next question. What are the challenges and pitfalls associated with investing in real estate, and how do you overcome them?
So when the market's doing really well, it's easy to confuse the market cycle with your personal intelligence. And for those of your listeners and yourself who've been around this business for a little bit, you remember the 08-09 crash and potentially for some of the other listeners that are, pre the S&L crisis. It's really easy to think that because the market is moving in a certain direction, it's really easy to think that you somehow have something with it. And I see this with some of my peers, where I see some of the underwriting now where they're getting really relaxed on, certain rigorous assumptions that you build into your performers. Well, now I'm starting to see a lot of bad habits developing on the underwriting. I'm getting deals sent to me where it's like, hey, the IRR on this is crazy. And I'm like, yeah, but your rent growth multiplier is insane. Like, I understand that there's things happening in the world right now, but you can't seriously build that as a standard expectation within your business model. So I think, to answer your question succinctly, the biggest risk in the business is when the markets are too good for too long, a lot of really bad habits show up. And I don't know about you, but I'm certainly seeing a lot of it today.
That's an important message. So if we look back at 2008, what did we learn? Did the underwriting change immediately after that? The answer is yes. But now you're looking at underwriting today in 2022, and you're seeing a situation here where we're repeating something, and on a global level, we may have something that's a little more challenging because we're dealing with energy on top of inflation. So it's going to get interesting.
You see a lot of even the debt providers. I mean, today you're seeing 5-year bridge loan, IO interest only, 5 years bridge at interest rates that you're not going to see in 5 years. And guys are going in and they're buying buildings. And, I get the same term sheets too. I see the same paper. And I think to myself, okay, I can use it. That's great. You want to give me IO? I have more free working capital. I need to raise less equity to do value add CapEx items. No problem. That's fantastic. But you also have to factor that as on the other side, like in 5 years or 3 years, when you're going to refi or sell or whatever you're going to do with the asset, when you have to refinance that asset or negotiate new paper, what is that going to look like? And my fear is that people are building in the future based on what they see today and they've seen in the past. That's the $1 billion or potentially $1 trillion question right now. Where's that going to go, right?
Well, you know where it's going. Some of our listeners know exactly where it's going to be going.
Yeah.
The average individual does not.
Yeah, and that's a shame. And I kind of touched on the whole inflation conversation earlier. Look, I was born in communist Poland, and in 1995 we had what was called remuneration. And for those that don't know, remuneration is when they roll back the currency. So I distinctly remember in 92, 93 going back to visit my grandparents, and my grandmother gave me $1 million bill, a $1 million bill. And I'm looking at this thing because I'm thinking in the context of North America, right? What $1 million was then, let alone what it is now. So I go to the store, I'm like, grandma's a baller, like she's just rich. I go to the grocery store, I buy like a Coke, I buy some bags, some chips, some gummy bears, whatever it is, and I come home with like $300,000 in change. Well, right? Like, it was insane. And then wouldn't you know it, a couple of years later in 95, as it turned out, they rolled back the currency. They had the remuneration. It was 10,000 to 1. So everything got rolled back. So if you were sitting on cash, you got wiped out. If you were sitting on fixed debt, if you were the holder of the debt, you got wiped out. If you held the underlying asset, i.e. real estate, tangible assets, whatever it is, you owned the building before, you own the building today. And if anything, the debt that was attributable to your building has now been rolled back relative to the currency, right? So, again, at that point in my life, I didn't recognize what it was, but in hindsight, that, the people that held on to the real estate during any of those inflationary events managed to preserve their real purchasing power.
That's true wealth.
Yeah.
Are there any recession-resistant assets? And if so, what are they?
Well, I think when you look at real estate, and not all real estate is equal. Obviously, we've seen a lot of fluctuations with the recreational market and other subsectors of the commercial real estate office. Obviously, has gone through a heck of a transition here. I look at the real estate that I'm focused on, multifamily, and there's other markets as well, but we like the Southeast. And what I like about it, recession resistance perspective, I like that word, by the way, is that I believe, like so many others, more and more now, that this inflation thing is a real thing. It's not transitory. It's here to stay. It's unpacked its bags. It's set up its camping. Like it's here. We're going to deal with it. And I think we're going to have multiple years of inflation, obviously, more than the 1 or 2% target that obviously the Fed's always had. And I look at the apartment buildings that we look at, or the ones that we own, and I look at a packaged commodity play almost, because the replacement cost of that building will continue, in my opinion, to increase drastically. So all the labor that's gone into the building, the materials, the concrete, the walls, the electrical, all the copper, the wiring, all the stuff, all the inputs, they're all commodities. And I mean, you can buy them individually on the stock market, you can trade in the various commodities, or you can buy it as a packaged product on dirt that people need to live because it's near, hopefully, where they're working. And on top of it all, the bank will give you fixed debt for 30 years for it. I mean, what's better than that? Now, as long as you can hold on to the property. The thing is, you got to hold on to the property, right? And that's one of the demons of real estate, because the bank will give you money. They will also take that asset from you if you can't make your payments. And being over levered is, well, we've all seen that. So
right. It's always about cash flow.
Yeah.
Positive cash flow. Tell me about your process of due diligence and how do you simplify the process while executing it at a high level?
So, like yourself, I get a lot of opportunities daily, weekly, text messages, emails, phone calls about deals all across, the US. And for me, the first thing is, first of all, we pick our niche. So I like the South and I like the Southeast because the investment thesis, the migratory patterns, there's a certain investment thesis that I believe in. People are running from the snow, they're running from high taxes, they're running from high regulation and things like this. And whether it's Florida or Tennessee or Texas, Georgia, that, the southern states, I believe that people are going to continue to move there. So for me, I keep it simple and I focus on those markets throughout the South, Southeast, because I think that's a long-term overarching trend that I can just follow. As far as simplifying the process, for me, I don't go into the size of deals that I know the traditional private equity guys are playing in, because if you're even, it used to be 50 or $100 million deal size. Now, even if you got a $25 million deal, you might get someone showing up, on one of the walkthroughs that is private equity. And I mean, traditional private equity, the big boys, the royalty of the industry, so to speak. And I never want to go up against those guys at the bidding table because they've got cheaper debt. They've got cheaper equity. Their cost of capital is much lower. So of course that is reflected in the price point. So for me, I keep the transactions smaller, below 20 million, ideally, 15, $20 million, $10 to $20 million is probably a good range. If we enter a primary MSA, we'll typically be on the secondary side of it. So, and actually tertiaries are starting to become more attractive too, because of the whole COVID and people transitioning out of the downtown, so to speak, and looking for that smaller community feel. Another piece for me is, I'm old fashioned. I look at gross rent multipliers. So for me, GRM is really important. For those of you who follow that, I like to keep my GRM below 10. It's kind of a back of the napkin. It doesn't tell you that the property is going to cash flow, but it will give you a good indication of whether you're kind of wasting your time or not. So for those of you with GRM is gross rent multiplier. So if the rent is $1,000 a month, and then that's the market potential, that's $12,000 a year. If you multiply that by 10, you wouldn't spend more than $120,000 for that individual housing unit. Now, if the rent is $2,000 and your purchase is still $120, then your GRM is 5, and that's tremendous. So obviously, the lower the GRM, the better off you are. And then you look at things like employment, net migration, transportation. If you have more heads, you need more beds. There's just certain truisms in real estate, and I still avoid the really small communities because I had a deal come across my desk in Jacksonville, actually just west of Jacksonville, Florida, and beautiful property, fantastic purchase price, but it was 50 miles out of town, out of the MSA, and there was maybe 3,000 people around. So I'm just like, okay, so everybody in this 200 unit building lives in this town, or so it looked great on paper. Everything was fantastic, but again, too far out. So those are some of the major things I look for.
So you brought up private equity at this point, that they're cashed up. We see a lot of money coming in from overseas, and we see it's creating in sort of higher prices for deals versus if we look back 3 to 5 years back at this point. The question is, will that trajectory continue at that level with the overseas infusion of cash, and how it's going to increase the multiples on the value of buying in your space?
Well, I always like to ask the question. I have to borrow this from Jason Hartman. I've seen him say this a few times. People say things are expensive. Well, expensive compared to what?
Very good.
And that whole compared to what comment is really interesting to me, because we think things are expensive relative to what we've seen. But when you compare that on a global level, there's a reason why money flows into the US, whether it's from Europe, the Middle East, wherever it's coming from, even from Canada. You have to look at these other countries, because I can give you the example, Canada. If you look at Toronto, Vancouver, major MSAs throughout Canada, cap rates for comparable assets are coming in with a 2 handle. So you've got low twos, high ones. A three is a unicorn. Good luck finding a three. So, I know that some of my peers, maybe some of your peers, are complaining that the prices are getting bid up, but again, expensive compared to what? And for those people that don't know this, as far as I know, the US is the only country in the world that can give you fixed 30-year paper. Because I can tell you in Canada, it's 5 to 10 years. Most other parts in the world, it's 5 to 10 years. So when you can take that 30-year agency debt and put it on an asset, that's your fixed cost for 30 years. I mean, you've got a spread on the coupon with the bank right away. I mean, if inflation's running 7% and you can get fixed 3-4% debt, I mean, you're already ahead.
Very well said. What are the current trends you see in the general market currently or going forward? Any insights you have?
So I was reading the last Marcus and Millichap there. They got this multifamily report that they put out. I think it's quarterly. And what kind of caught me this time around, I mean, they've said it before, but for some reason it hit different this time, was I noticed that there is a very large increase in the amount of people under 35 staying at home. And to me, that was, like in other parts of the world, it's not unusual for you to have 2, potentially 3 generations living in one roof. It's actually very normal. You look at France, you look at Italy, Germany, Poland, most of Europe, other parts of the world. It's very normal for, people to stay at home well into their 40s, sometimes even have their kids, then they have their kids, the parents are there, effectively the grandparents, and that's normal. And I think my whole point is that happens in that part of the world because affordability was, you have 100-year mortgages in parts of Europe, as an example. We don't have this in the US or North America. You have 30, 35. I know in Canada, there were 40-year AM schedules for a while there as well. I think they've cut that back. But the housing costs are high for us. Again, expensive compared to what? They're expensive for us here. But when you look at other parts of the world, you have 3 generations paying off a 100-year mortgage. So I'm not saying this in a positive way. I don't like this, but I think the US and Canada is trending in the same direction that the other parts of the world are. And when you look at it, the US and even Canada, I mean, these countries are, a couple 100 years old. My town in Poland is over 1,000 years old. Right. So, and it's been occupied by the Germans, by the Russians, by all kinds of, but the point is when you have communities that have been there for sometimes 1,000+ years, 100-year mortgage is, it's a different context, right? It's a different outlook. And I don't think it's difficult for people that have grown up in the US to recognize that if they haven't seen that type of living arrangements elsewhere in the world. So long rant to a very simple point. I think one of the biggest trends is people are obviously going to stay home longer. You're going to have more generations at home. And the people that do manage to move out, I think they're going to be adjusting to smaller spaces and more of a communal living outlook. So you're starting to see smaller suites. You've got the bachelors, the efficiency suites, especially here in Florida, Tampa, Orlando, Miami, where rents have gone nuts. People are literally retrofitting motels and they're moving into 200-300 square feet suites with full kitchen down one side, bathroom, closet, and you got a Murphy bed, and that's your space. And people are paying $1,000, $1,200 a month for these because they have the community, they have the business center, they have the pool, they have everything around them, and they're out of necessity okay with a much smaller private space, but at least it's their space. So I think those are 2 really big trends that are going to continue on.
Thank you for sharing that. What motivated you to share the knowledge you have acquired with others?
So I've always been a teacher. Ever since getting into this stuff, I enjoy just teaching. It's fun for me. It's a passion. Sharing information has always been a lot of fun. I think what really put me on the path of these podcasts and videos and all this other stuff was when COVID happened. Like everybody else, life ground to a halt for a few months, and you're stuck at home. I'm used to being, I don't know about you, Cliff, but I'm used to being on a plane 50 to 75
Okay.
times a year. So, all of a sudden, all flights are canceled. Everything is, everyone's buying toilet paper. it's just madness. And you're at home, and, home's great, but eventually it became, I was looking for something. So through COVID, I guess, you make the most of it. So I got, like yourself, I got used to the Zoom, the podcast, the videos, and, really found another forum to motivate, inspire, and share stories with people. So
it's a good message. Very, very solid educational material that you bring forth to the industry. And thank you for that.
Mm-hmm.
Is there anything I haven't touched on that you would like to add or expand on?
I think we would be remiss if we didn't talk about inflation for at least a minute or two, because it is, I know I kind of mentioned it earlier, but I can't stress how important the inflation conversation is to your viewers, to your audience. I'm sure many of them are well aware of it. We all see it when we go to the grocery store.
Mm-hmm.
My wife and I, we had a baby 5 months ago.
Congratulations.
And thank you. And I'm learning about diapers and formula and all this stuff. And I see it every time we go buy formula. It's like, I swear, every time I go to buy this stuff, it's like 50 cents, 70 cents, 80 cents, $2 more every single time. And I'm like, this is insane. So they tell us inflation is 6-7%, whatever it is, but we all inherently know that it doesn't feel like 6% per year. I mean, just look at the pumps, look at the price of your house. And I mean, look, government's fair enough. They want to do what they can to limit the perceived increase in inflation. So they have, things like owner's equivalent rent as one of the variables in how they measure, inflation, and that's fine. But it's not a true reflection of what's going on. So my point is, if you believe, like, it's really simple. You either believe that inflation is going to be here to stay for several years to come, or for whatever reason, you think that, they've got it under control and it'll stabilize. If you think that the inflation conversation is going to be a permanent feature of life in North America, then in my opinion, your best bet is to buy cash flow real estate with good, sound, long-term debt in markets where, regardless what's happening, there's going to be jobs. Because if you run a calculator, and this, I would never do this pre what's happening today, but because it was always considered that you run a 2 or 3% appreciation within your models. But just based on, if you take what's happened last year and what's happening this year, and let's say 7% is an honest number. If you multiplied 7% compounded over a period of 5 years, you've almost got a 50% increase in the asset value just off the inflation itself. So how does that transfer into the replacement cost? How does that transfer into valuations? It's possible. And here's something else to share. It's possible for our economy to crash in real terms, but appreciate in dollar terms. And this is something that we're not accustomed to, because we haven't seen this. And last time we had something like this, I mean, I was still growing as a baby, and, interest rates were in the 20s and, high 20s and things like this. And I don't see that happening again, because the government's in debt this time around too. So, last time around, the government wasn't carrying the kind of debt load it is today. So it wasn't,
you get over 30 trillion in debt.
Yeah. So, I mean,
we got some serious conversations on a global level between China, Russia, Saudi Arabia, looking at, should they be buying oil in dollars, or are they going to use some sort of other basket, or the gold standard, or Russia's asking for things to get paid in rubles at this point. So you can see they're trying to marginalize the US and the dollar, and it's about the federal debt.
Well, Cliff, I was going to say that's the elephant in the room, but actually we probably have like 3 or 4 elephants in the room right now. There's, we got a whole circus going on, right? And the best analogy I think I'd heard to sum up the current state of affairs is the US is the cleanest dirty shirt at the party right now.
Insightful.
So, and the world still wants to be here. So I'm bullish on it. I think it's going to be interesting to see how things get navigated, but I don't have a better idea than multifamily real estate. I don't know how else to say it.
How can our listeners contact you, and are there any links you would like to share?
Sure. My website, marcindrozdz.com. Hopefully you can put that in your show notes because there's a few Z's in there.
Well, spell it. Go slow and spell it. Sure.
Sure. It's marcindrozdz.com. That's my first last name.com. So, on the website there, we have a lot of different resources, people that are looking to structure their capital deals. We have an inner circle for people that are looking to raise capital and scale their real estate portfolio. And of course, I have M1 Real Capital for people that are looking to be involved. They want to be invested in real estate, but they don't want to be real estate investors. And of course, there's a big difference there. So
I want to thank you so much for your time, Marcin. Your determination to succeed has yielded positive results, and our listeners are fortunate that you've shared what you've learned. Thank you for coming on. Thank you to our listeners. I look forward to being back with you shortly for another episode of the Private Equity Profits Podcast. This show has been produced by Market Domination, LLC.